If you only short UVXY with 5% of your portfolio, it would have to go up 20 times to lose all your money, which probably won't happen. I don't see why this is risky. Okay, so now we're getting to the heart of it. How dangerous is shorting just 5%? So you have to remember that even though from your perspective, you have only shorted 5% of your account, you have to remember that the broker perspective is that they are going to require you to hold the margin requirement, the maintenance requirement to keep that position open will be 3 times your position. So it won't be 5%. From the broker's perspective, it'll actually be 15. So that means that even if the rest of your portfolio is in cash, it only has to spike about 6 or 7 times and you're screwed. But it's worse because in a crisis, they will definitely raise margin requirements and it could go to 5 or 6 times. And that means that, again, from your perspective, you have used 5% of your cash. But from their perspective, you've tied up 30 because they can't allow you to just do reckless things and cost them money. So in a crisis, they raise their collateral requirements as well. So now you're taking up 30%, even though you won't technically lose, quote unquote, all your money because the cash value won't actually devastate you. As far as the trade, it's over when it's up about 3 or 4 times. Like you're done. They're not going to let you continue. You can't call them up and say, don't worry, I have a plan. They don't care about your plan. They're just going to protect themselves and close out your trade. So you are going to get margin called quite quickly on this process. It is not going to require a 20 times UVXY spike to get a margin call. It's going to happen much, much faster than that. This would be more than enough to do it. You're going to get asked to deposit capital into your account after 3 or 4 times spike. And you're certainly going to just get auto closed out very shortly after that. So don't mess around with highly capital intensive margin positions.